Hello, everyone. Welcome to this webinar with the management of RateGain Travel Technologies. We have with us Mr. Tanmaya Das, who is the Chief Financial Officer of the company. Also, we have with him the Investor Relation, Mr. Divij. Welcome, both of you, sir. We would also request all the participants to note down any questions if they have regarding this webinar or regarding the RateGain technology. And after say 15-20 minutes, we will begin a Q&A session where we will take few questions from the audience itself. Hi, Mr. Tanmaya. Since IT as a sector in India is kind of growing, and we have seen that people have not been able to differentiate between many different aspects of IT companies. So, can you brief the viewer regarding your company and the business it is in?
Sure. Thanks, Jayesh, and good afternoon, everyone. As Jayesh said, like we need to give a brief overview of the company, and we can then take the Q&A after 15 minutes. So I'll request Divik to go over a short presentation that we have, which will give you a very good idea about what RateGain is and what are our offerings and what are the updates in past quarter and all. So Divik, over to you. Thank you.
Perfect. Thanks, Tanmay. Thanks, Jayesh. And a very good afternoon to everyone attending this session. I'll try to keep this brief. I'll give a nice 15 to 20 minute overview, and then we can kind of open it up for questions from there. So I'll just briefly kind of touch upon the vision of our company as well as and then I'll cover the different aspects and the three main business verticals that we have within the company. So clearly, our mission and kind of vision within RateGain is to be the leading revenue maximization platform for the hospitality and travel industry. We are not so much an IT services company. We are a SaaS-based platform that we have built over here, and there are certain inherent advantages to a SaaS business model, which I'll touch upon a little later. When I say revenue maximization, what I basically mean is that we are in the business to help our customers to make more money. And we intend on doing that by doing three main things, which is mainly to help our customers to acquire guests, to retain and engage with them, and have a wallet share expansion with them. So these are the main kind of focus areas for us over here at RateGain, and this is the kind of vision that we are working towards. I mentioned these couple of things that one, of course, we intend in terms of the near-term growth plan and the roadmap that we intend to be within the travel and hospitality space because we see a good growth opportunity over here. Along with that, we mentioned the RevMax platform that we're trying to build over here, mainly to mention that our focus entirely is what we like to call as the front office or the commercial office of an organization. So usually within a company, there's the front office, there's the mid office, and the back office that's kind of more focused on operational led areas. Our focus will be on the customer facing commercial office teams of an organization, and that's what we intend to kind of focus on. With that, another reason that is there is that another key cornerstone of our growth plan and roadmap is going to be our inorganic strategy that we have, and we've recently just completed an acquisition as well, just earlier this month, that I'm sure that you must have read about, and I'll briefly touch upon that too. So M&A is also a key focus area, and any M&A kind of strategy and growth aspirations that we have on that front will be keeping in mind that it kind of complements our strategy in terms of creating and having this integrated technology platform, which is focused on revenue maximization. We have three key verticals within RateGain, which are known as data as a service, distribution, and MarTech. And while these terms might not be very familiar, I'll take just a couple of minutes to give you a contextual kind of an example as to how these kind of three areas kind of come into play and help our customers, and how we work with the different facets of the commercial team of an organization. And I'll take the example of a hotel, because we do 80% of our revenue comes from hotels, and that's where we are present across all our three verticals. So within a hotel, typically there is a revenue management team that is given certain sales goals at the beginning of the year that they kind of go ahead and break down into a monthly basis. And once they've kind of broken down their monthly basis, then they need to kind of figure out what kind of pricing I need to have to be able to meet my sales goals and to kind of fill my hotel and have the best possible outcome in terms of the occupancy I want in my hotel, because we very well know hotels have a perishable inventory. Whatever number of rooms they don't sell out at the end of the day, they kind of, that's kind of a lost opportunity over there from their perspective. So for that, they have to come to their pricing decision, and one of the key ingredients that goes into their pricing decision is the competitive rate data. They look at what their goals are, they look at what kind of occupancy or reservations they have for a certain period. They look at what is the run rate at which they are getting the observations, and at that time they have to do a comparison in terms of how they stand in regards to their competition. In terms of a simple example, if we take the example of a Trident hotel in BKC, the Trident in BKC wants to know what is the pricing at the Sofitel in BKC, Taj Lands End, the Grand Hyatt in Santa Cruz, couple of airport hotels that it considers to be its competition set. It wants to look at these pricing, and we provide this information to the hotel, to the revenue management team in a nice dashboard, where depending on their revenue strategy, they get a clear view as to whether their pricing is in line with their competition set, and if it's supposed to be 10% higher, 10% lower, or at par with them. If there is certain movement that's happening amongst the competition set that they have raised their prices, maybe they're seeing an increase in bookings due to an event. Maybe the hotel itself might want to increase their prices and know about it today rather than knowing about it 2 or 3 days later, because that could be a lost opportunity from their perspective. So this competitive data intelligence is one of the key services that we provide, which is known as DaaS, data as a service. This is the one kind of vertical where we are present across the entire breadth of the travel and hospitality space, where we work with OTAs, we work with car rental agencies, we work with hotels, we work with airlines, with vacation rentals, cruise lines. So we work with all of these different kind of sub verticals within the travel and hospitality space within our DaaS segment. Moving forward, in terms of once they've kind of used this input and kind of determined their pricing, then comes in how are they going to distribute their inventory. They need to then sell out their inventory, and there are two main methods for them to kind of distribute their inventory. One is online and offline. Offline method is that would be related to certain events that they have coming in. They might get certain calls to their call center. They might have a corporate sales team in place that kind of interfaces with various corporates and government organizations to get some bookings. So that is one aspect of them selling out their rooms. The other mode of distribution or distributing their inventory that they have is online, in which they have three main modes of distribution. One is through OTAs, what we know as online travel agents, like an Expedia, a Booking, a Yatra, or a Make My Trip. The other mode is that they can do it directly through their website. And the third option is that they can do it through what is known as GDS, which is a global distribution system, which is mainly for corporate related travel bookings that come through travel agents. So that is what is there. So our distribution kind of business model is focused on helping. We provide a platform that helps the hotels to connect with various OTAs, as many OTAs as they would want to be connected with. We can help provide that connection to them. And through this platform, hotels are able to showcase their availability, their rates, and their inventory across various OTAs. And whenever a booking is done on an OTA, then that booking flows back to the hotel through our platform. We send out the reservation and kind of close the loop over there. So that is how we kind of help. Here we are present with OTA. We provide the connectivity platform for connection for hotels with OTAs and with the GDS system, which is through basically corporate travel and global and the travel agents is what we do. So this is how we work with the other kind of facet of the commercial team. And then comes the third aspect, which is the marketing team, where basically we do three primary things. And this is mainly helping with the other mode of online distribution that a hotel has, which is directly through their website. So our main kind of service that we provide over here is brand engagement and brand monitoring, which is across all social media channels, your Facebook, your Instagram, TikTok, Snap, LinkedIn. So we manage the entire brand engagement for hotels across these different channels. Along with that, we provide brand monitoring services where we are able to capture any reviews that might be written about any hotel and to be able to actively respond to it, as well as flag it off in case the guest is having a negative experience, so that the hotel can mitigate any downside from that. The other service that we provide within our MarTech division is what we call as paid digital media, where we run various campaigns for hotels to basically help direct more traffic to the hotel's direct website and to enable more direct bookings to happen on their website, which is across different modes. So one is across the different social media channels on Google, as well as on meta search sites, which are your price comparison websites like a Kayak or a TripAdvisor or a Trivago. So we help in terms of helping hotels get the right visibility and showcase the right price points for them to get a direct booking as opposed to that booking coming from an OTA. And the reason for that is, and how beneficial that is for a hotel, is basically whenever they get a booking through an OTA, they have to pay anywhere from a 20 to a 30% commission. Whereas if they can get a booking by doing a certain amount of marketing spend and get a direct booking on their website, there's a huge delta in terms of margins that they can save over there. So this is kind of how we work across the different kind of, this is how our three businesses are aligned and how we work with the different aspects of the commercial team of an organization. With that being said, briefly touching in terms of, as you can see over here, in terms of our last quarter performance, we have been growing at a fairly good pace at about close to about 47% growth year on year in terms of our opening revenue. I'll just briefly go back, take a little step back and go to the time of our IPO roadshow, where we had given a guidance basically that we would be growing our revenues for the next kind of 3-year guidance that we had given at about a 30% year on year growth rate is what we would be seeing organically within RateGain, and looking at improving our margins at about 200 to 300 basis points year on year. At that time, we were at about a 10% EBITDA margin. So I'm happy to report that we're doing, in the 4 quarters of results we've declared since then, we've either met or exceeded the guidance that we had given, where we've been growing at a good click of about 47%. Our organic growth rate was about 33% in the first half of this year. Our margins have expanded in line as mentioned, or actually ahead, where we are at 15% EBITDA margin. And happy to report that even on some of the other metrics in terms of our revenue model, where we have a 77% subscription-based revenue and a very high recurring revenue percentage, which makes the revenue model of a company like ours more predictable, more reliable, and more sustainable. So that's kind of the inherent kind of benefits that we have with this business model. Briefly kind of touching, I kind of mentioned in terms of our subscription revenue being about 77% of the total revenue, and about the balance is transactional revenue that we get. We've got a fairly good diversified spread in terms of geographic presence that we have across the globe. But we get about 56% of our revenues from the US region and about another 31% from Europe, with the balance kind of coming from APAC and Middle East, and India has a small presence in terms of our portfolio right now. Um, this slide basically just captures some of the other key metrics in terms of how we are performing, and happy to report that on a annual recurring revenue basis that we are about 22% higher than our pre-COVID levels as of right now. And we've seen some good growth in terms of the new customers that we've been adding on a quarter-on-quarter basis, as well as another key metric is that's kind of clear, very closely tracked, is the revenue per employee, where currently we are at about $100,000 at a revenue per employee, which is fairly kind of a good number, and we kind of aspire to take this higher as well over the coming kind of quarters. The slide kind of captures real quickly in terms of the inherent benefits that we were talking about in terms of a SaaS business, where we, as our kind of the benefit of being a SaaS business and a high gross margin business, is the fact that as our revenues kind of start to scale up and start to grow, there is a bit of a non-linearity in terms of our cost to our revenues, where our costs don't necessarily need to increase at the same pace as we have our revenue growth. And that is why the incremental growth that we have after reaching a certain scale, kind of there's a more and more percentage of that kind of flows directly to the EBITDA and to the bottom line. And what we kind of like to follow is a rule of 40 within the SaaS spaces, which is a combination of the growth percentage plus the revenue percentage. So happy to report that we are in excess of we are closer to about 60% right now, and we kind of on an organic basis we are at about closer to 50%, and we kind of hope to kind of keep that number at a higher click than what it's at. Very briefly, I'll just take a couple of minutes to touch upon the recent acquisition that we've done, which is a Silicon Valley based company that we recently acquired just earlier this month, which is a company called Adara, which is again a very kind of a powerful platform based play that we've where they basically have a data consortium of about 270 of the large global travel and hospitality kind of companies, where they're able to capture travel intent, which basically means anyone who's looking to kind of travel and starts that search process, they are able to capture that information and be able to leverage that information for providing a better and a higher ROI on any marketing and performance marketing related campaigns. That's what the company does. It's one of the largest data consortiums globally, where they have over 1.6 billion profiles. And the company currently has a revenue of about $27 million. And the acquisition that we did was the total price for that acquisition was about 16 million. We are going to be onboarding where we have done an asset purchase where we just kind of buy all the tech, the platform, the customer contracts. We've onboarded a majority of their team with that, but we kind of don't get any of the liabilities because that's just how the deal is structured, where we do not take any of the liabilities or any of the bad stuff. So we're kind of leaving that behind. And this kind of fits in well with our DaaS and our MarTech segments in terms of the two divisions that they have within Adara, which is one is where they provide this data and one is where they provide performance marketing related services. I think that kind of covers the brief presentation that I had. And with that, I think we'd be happy to take some questions now.
Thank you so much, Devik. It was really a great presentation. I hope all our viewers would have got good insight about your business. So now I would open the floor for the questions. and anyone who has questions can drop their questions in the chat box. We would be happy to take some questions. So already, Devik and Tanmaya sir, from our research point of view, also we have like couple of questions for you. So I hope you would guide us through the better understanding about things at RateGain. So my first question to you would be, see, basically, there has been a series of robust deal wins for the company, with the latest being with booking.com. Then we had seen a deal win at Royal Orchid Hotel, even at Akasa Hair. So does it provide a roadmap for a company for rest of the quarter, or as in, I just want to see what are your plans to increase the market share of the company? Can you guide us through that?
Yeah, sure. So yeah, so we these deal wins that you're referring to, so that's kind of par for the course and part of the regular kind of business operations that we have, where we have different kind of levels of conversations underway with our clients, and which are at various stages, and the deal wins that we keep on reporting are part of the process. But happy to report that Q3 again has been the second half of the year in terms of from a seasonality perspective generally is better, given that we do most of our business in the West, since they are closing their budgets around that time at the end of the calendar year. So it's second half of the year is generally stronger from a RateGain perspective, and Q3 is on track. Has been a good quarter for us in that sense that we've had some of the some very good kind of deal wins in this quarter, one of the highest ever actually in the history of the company, where we have closed some very kind of big and lucrative deals. I of course can't take any names in regards to that, but we've closed some good deals in that sense. And In terms of our kind of market share strategy, it's a combination of two, three things. One is, of course, RateGain is already present with all the kind of large names across the travel and hospitality space. So whether I look at, we work with we work with 400 plus of the largest hotel chains globally. We work with all the top OTAs. I think 23 of the top 25 OTAs in the world are our clients. We work with all the car rental companies. Airlines is a new segment that we've gotten into very recently, about 3 years back, and we are growing in that segment. So we are already present across these kind of big major players across the travel and hospitality space. So a big part of our growth strategy would be a combination of kind of cross sell and upsell to these existing clients and these existing relationships that we already have. Cross sell is a function is, given that we have such a wide product portfolio now, and with the recent acquisition that's only grown, we would be, there's an opportunity for us to cross sell some of the products that they're not currently using from us. So that's one opportunity that we have. The other opportunity in terms of upsell, when I say, that's more in terms of deeper penetration with our existing products and relationships that we already have ongoing, as well as a volume growth that will kind of play out for us over there. So that's kind of the combination of kind of strategy that we have in terms of us expanding our market share. And the strategy kind of varies across the different segments, but overall it's a that this is the kind of big picture kind of focus in terms of how RateGain is going ahead with its growth plans as of right now.
Great, David. We have one more question. It is from one of our client. He wants to know that since you have acquired Adara, so as in what is the expected increase in the wallet share? As in, how much growth are you expecting Adara to help RateGain growing in the futures, and what are the impacts that would be seen in the margins and all? So basically, his question is that how much top line benefits would come after the acquisition of Adara? If you can guide us with that.
I can take that, Divik. Hi, this is Tanmay. So yeah, Dara, as Divik was talking about, like it's a the revenue size is around 200 crore or $25 million per annum at this point of time. It's too early to say how big it can be because it really can be very big. At pre-COVID, the company was had a revenue base of around $100 million. Post-COVID, they has undergone a lot of stress in that company, so they have not been able to go back to the glory days of pre-COVID because of multiple reasons. But I think there is huge opportunity to, if we can execute well, we can go back to that kind of level of revenues in that company. For the immediate projections that we currently have for next year, 23-24, we expect to grow the business by 15% year over year. That's the initial assessment at this point of time, but there is a lot of effort that is going to go into to reactivate the lost relationships because we already have those relationships with RateGain. But I think it will take some time, at least 6 to maybe 12 months to have a better assessment how big it can be. But initial assessment is that for the next 1 year, the revenues will be little bit subdued with a 15% growth that we can expect. But I think we will be in a better position for, after 6 months of integration, really how big it can be. Because it was really big before pre-COVID. In terms of margins, currently the company is breaking even, but we have already on day zero we have already taken out a lot of cost because out of 60 people we only migrated around 50 odd people, which because there is a lot of synergies between the two companies, and also there is a plan to reduce or migrate the shared services to back to India so that we save a significant amount of money. So we expect to turn the company to profitable within first quarter. And but next quarter, I think next year again we're targeting a 15% EBITDA. We can convert this company to a 15% EBITDA company, and so that's on a standalone Adara how it's going to look for next year. There's a 15% growth and a 15% EBITDA margin. That's what we're targeting.
Great, sir. We have one more question. It is from one of our clients. So he just wants to know who are the competitors of RateGain and how would the company make money by providing services to the hotel industries and airline industries. He just want to know if you can brief us.
Yeah.
Yeah, it's very hard to pinpoint one particular competitor because we have got multiple business units like DAS, distribution, and Martech, and each there is no company in the world which has this product. Because the closest I can think of is Amadeus, which is a few $1 billion company, but they have a subset company called Travel Click as part of. They acquired that company back in 2018. At that point of time, the revenue size was around 330, $50 million. So we primarily compete with. There is the closest competitor we would have, but there are many regional players in each of the business segments that we have. Like DAS, we have a few competitors like Fonova and Fair. In distribution, we compete with a company called Derbysoft, which is a Chinese company. In Martech, we now compete with Cody, we compete with Sojourn. So there is different competitors in different segments, but we after the Adara acquisition in the hotel tech space or to hotel travel tech space will probably be the third largest company in the world after Travel Click and Sabre. In terms of the way we make money, again, the pricing and the business model is different in different segments. Like as Divik said, like 75% of our revenue comes from subscription-based revenue and 25% is on transaction-based. Uh, we prefer more subscription-based revenue because really in bad times, subscription revenues hold hold its ground, and whereas the transaction revenues really grow faster when things look up. So we have an optimum mix in that, but it's because the high subscription based revenue, the revenue models are pretty predictable, scalable, and resilient. Um, yeah, I think that's what I would say about this.
Yeah, great, sir. Now there is one question for actually me. Someone is asking me, why are you recommending a buy on RateGain Travel Tech, as it was earlier recommended by us as part of our Idea to Act recommendation at 285, and now since the target has achieved, are you still bullish on the stock? So basically, as a in-house view, we have a very bullish view on the stock. In this platform, I would not be recommending any target price or something. It is just related to a informative webinar where the management is posting their views. So with respect to the research that we already have a research note on the stock, and you can definitely see through the report. We have already mentioned all the reasons why we are bullish, and we are bullish on the stock with the target price of 425. Now we will take a couple of more questions, and then we will conclude the call. So or else we can take a last question. The question is from our fund manager, Mr. Ujwal Shah. So he is asking, what are the sustainable margins with rate gain, which rate gain is targeting in medium term?
So, okay, last year and even during the IPO, we were at a 10% EBITDA margin. At the start of the year, I had given a guidance that we will improve our margin by 200 to 300 basis point every year. So we're targeting between 12 to 13% in 2023. But happy to report that we're exceeding that guidance. We probably be closing this year around uh, between 14 to 15%, so almost 400 to 500 basis point improvement. Primarily because some of our profitable business segments like DaaS and distribution have kind of exceeded our expectation and grown faster than what we expected. But again, with Adara coming in, again, as I said, currently the company is breaking even, but we are kind of, we've done that company profitable within 90 days. Uh, Still, including Adara in Q4, we should be in the range of 15%. It will not dilute the margins in any way. But next year, we expect to again, including Adara, we expect to deliver a 200 to 300 basis point improvement over this current year. So if we close this current year around 14.5, 15%, then you can expect another 200 to 300 basis point improvement next year. That's the plan. In fact, that's what we have been targeting, that we can, with the 30%, close to 30% organic growth, we can deliver this kind of operating margin improvement because of the operating scale or that we'll get, or operating leverage that we'll get.
Yeah, and just to add on top of what Tanmay was saying, so both our DaaS and distribution business, they are fairly high gross margin and high EBITDA margin businesses, with about 80-85% plus gross margin in each of the business verticals, and about 20 to 25% plus gross margin in each of those verticals. So as we kind of grow, and that's the kind of the operating leverage that kind of kicks in, that as we look to kind of scale up these businesses, and we are given the good traction that we're getting in both of these verticals, and even within in our MarTech vertical, we envision that kind of the the costs are not linear to the revenue growth that we kind of are looking to get in both of these verticals. So that's kind of where a lot of the kind of margin growth will be coming from as well, kind of going forward for us.
Great. With this, actually, we do have like 15, 16 more questions, but due to the scheduled timing, the webinar was of just 30 minutes. But we are glad that Tanmay and Divik explained everything to us in details. We would not be able to take any more questions from here on. I would like to thank Tanmay ji and Devik for joining us. Also, I would like to thank each of the attendees to attend the webinar. Many people have been asking about the PPT of the webinar. So we do have a research report. You can write us at research@ifl.com. We will be happy to share you the research report of this talk, which can be of your use. So, Tanmay ji and Divik, in case if you want to have any closing comments.
Divik, do you want to conclude?
Yeah, I think no. Thank you to IFL for hosting us, and thank you to everybody for participating in this webinar. I hope you found that useful. I'd be happy to kind of connect with anyone, or if they have any further questions or would want to understand the business a little better, that's what I'm kind of available for. So if anyone would want to connect, we can facilitate that through Jayesh and his team over there. But otherwise, you know, we're one of the very few profitable global SaaS companies anywhere in the world. So we are, and we have, given the kind of tailwinds that we've had and the kind of tough period that we're all kind of coming out of, especially being part of the travel and hospitality space, we are fairly kind of bullish and optimistic about the near-term outlook in terms of the growth and the some of the digitization initiatives that are kind of underway across the entire space. And that's where our services kind of become, I think, more and more relevant for a lot of our customers. And we are fairly optimistic about the kind of way forward and on delivering. And with this recent acquisition, I think it really adds another real. It can be another very kind of good acquisition in terms of the price that we paid for it, plus I think the value that we can kind of extract from it, and how it helps us to kind of deepen our relationships further with our customers. So I think with that, we are fairly optimistic and bullish, and I think I think that kind of sums up in terms of the brief summary that I had in terms of on the company.
Thanks, Divik, and thank you, everyone. And thanks, Joyce, for arranging this webinar. Thank you.
Yeah, thanks a lot. Have a good
Thank you.
evening. Bye.
Thank you, everyone. Have a good evening.